So not only does the federal government collect taxes, but the states and the local governments also collect taxes. So since this is something that each level of government has the ability to do, we call that a concurrent power. So power for the federal government is something if they have the sole power, no one else can do it. Or if states have the reserved power, no one else can do it. But taxation is something that we allow all levels of government to do. They all happen at the same time, and they're not taking away the other's ability to do it here. So there are some things that the federal government taxes that the states and the local governments don't. And there's some things the states tax and the local governments tax that no one else does, right? And so they're all responsible for funding certain things as well. So, for example, the local taxes that you pay don't go to fund national defense. That's federal tax dollars that go for that. So, like I said, under the Articles of Confederation, we said the government can't collect taxes. And when we rewrote the Constitution, that's one of the things that the framers of the Constitution added into it. So we know the government has the power to collect taxes because in Article 1, Section 8, Clause 1, they first thing they say Congress has the power to do is to collect taxes, duties, and fees, right? And so that tells us it's probably an important thing for the government to do if it's one of the first things that are listed there. Okay, our states have structured their state constitutions off of our federal constitution, and so most states are collecting tax dollars as well. Each state does look different on how they do that because every state has different goals. And some states collect taxes that other states don't, and the rate of taxation is different because they all have the power to do that. Okay. We also know the government can collect taxes because of the 16th Amendment. So in 1913, the 16th Amendment was passed, and that gave the government the ability to directly tax individuals on their earnings, which means we now have a federal income tax. The government takes money from your paycheck to help fund government programs, right? So prior to 1913, that wasn't a thing. Your state governments could do that, and then the state legislatures would pay into the federal government for that. But the government did not directly have the power to tax individuals' earnings. Okay, so after they were able to do that, that significantly increases the revenue that the federal government has. If you remember looking at the websites last week for government spending, individual income tax is the largest chunk of revenue for the federal government. That's where they get the majority of the money they have to spend. So this gives them a lot more money to spend, which increases government spending, and it also increases the power of the government. Whoever has the money to spend and is spending it has the power. And so we saw a big increase in the federal government, the size of the federal government. So, one of the questions when we're talking about taxes, and since nobody really likes to pay them, right, is should you have to pay a tax if you're not receiving the benefit from it? So, a lot of times we look at examples of this and say, okay, well, if we're talking about property taxes, a lot of that money goes to schools. So, if you own property, but you don't have anybody going through the school systems, should you have to pay property tax? Or if you do have people, you have children going through the school system, but let's say you're renting and you're not paying property tax, is that fair? And so if we look at this as a use, right? How often do you use government programs, government products, goods, whatever? And that should be your basis of taxation. That can kind of be hard to calculate on an individual level when we have so many people in the population. So instead, we just tax everyone for things if they use it, if they have it, whatever the case may be, and then that money goes towards funding for programs. So again, along this idea of fair and what is the fair way to tax, taxes fall into two categories really. One way you can tax people is something called a proportional tax. So this is one in which the rate of taxation is the same regardless of the amount being taxed. So that basically means that let's say you have somebody earning $400,000 and somebody earning $40,000 a year. Each of them would pay the same income tax rate. So both of them would pay, for example, like a 4% rate. So a proportional tax is looking at saying the size of your pie might differ, right? Somebody has $400,000, they have a larger pie than somebody only having 40,000. But the chunk that you're taking from each is the same. It's 4% from each is going to hit each of them the same. Now the dollar amount will differ, but the rate of taxation is the same. Excuse me. We also call this a flat tax because of that idea that the rate is the same regardless of how much or how little you make. So people who support this tax type of way of taxing see it as being the most fair because you are affecting everyone the same. It's seen as being an equal effect on everybody regardless of their income amount. The other way you could tax is something called a progressive tax. So, with this, as your value increases, the tax rate increases as well. So, if we're talking about income, as you make more money, as you progressively make more money, the tax rate will progressively increase as well. So, people who support this progressive tax believe in something called the ability to pay principle, which means that if you have more money, you have the ability to pay more taxes, and so you should be responsible for doing so. Okay. Because if you paid a lower amount, you would still be left over with plenty. And so, since we are thinking collectively here with taxes, those people should have to pay higher amounts. Okay. We see different taxes fit under these. So, for example, in the state of Indiana, our state income tax is a proportional tax. Everybody pays 3.3%. Federal income tax is a progressive tax. We have a tax bracket that everybody follows. Other states can be different than that. California's state income tax is a progressive tax. Some states have your property taxes are progressive taxes in most cases, right? As the value of your property increases, the rate increases. So that's one way that you can tell if there are multiple tax rates for one tax, it is a progressive tax. If there's one tax rate, it is a proportional tax. Now, there is one other classification here. It's called a regressive tax. That's one in which, as your income increases, the burden of paying a tax decreases. So, sales tax is seen as being a regressive tax as well because let's say you pay $10,000 in sales tax a year. $10,000 from somebody who's earning 40,000 is a lot more than 10,000 from somebody who's earning 400,000. So regressive taxes aren't done on purpose by the government, but because of the way life is and the frequency of paying a tax or the amount of the tax, it does sometimes hurt people at lower incomes more than it does people at higher income levels. Okay. So that's it for today. Tomorrow, like I said, we're going to talk about the calculation aspect of it. But go ahead and go back to the agenda and see what else there is for today.